Why did long-term capital management fail from bad hedging? Imagine a hedge fund that thought it had everything under control, using complex strategies to protect itself from market swings. But then, suddenly, things went very wrong. That's what happened with long-term capital management. They relied heavily on hedging strategies based on assumptions that didn't hold during a major market crisis. Their approach was to take large, highly leveraged positions in bonds and other securities, betting that prices would move closer to their estimated fair value over time. They believed that by offsetting positions in related assets, they could minimize risks and keep losses small. But the problem was, they underestimated how markets behave during extreme stress. When the 1998 Russian financial crisis hit, markets experienced a sudden flight to liquidity. Investors rushed into the safest, most liquid assets like U.S. Treasury bonds, driving their prices up sharply. At the same time, less liquid securities, which LTCM had bet on, fell further in value. LTCM was short on liquid assets and long on illiquid ones, so they faced huge losses. Their hedges depended on the idea that correlations between assets would stay stable, but during the crisis, these relationships broke down. The market's behavior changed so quickly that their models couldn't keep up. LTCM also used a lot of leverage, borrowing money to amplify their bets. While leverage can boost gains, it also magnifies losses. When prices moved against them, LTCM was forced to sell off assets quickly to meet margin calls. This forced selling pushed prices even lower, creating a vicious cycle. Their inability to quickly exit positions at fair prices worsened the losses, and the more they lost, the more they had to sell, which deepened the crisis. This failure teaches a lot about investing in commodities too. Markets can shift suddenly, and liquidity can dry up fast. Relying on historical relationships between prices or assuming that liquidity will always be available is risky. Overconcentrating in similar positions or using too much borrowed money can make losses worse during shocks. Hedging strategies need to be stress-tested against extreme scenarios, and investors should always be aware that market relationships may not hold in times of crisis. LTCM's downfall shows that relying on assumptions of stable correlations and liquidity can be dangerous. It highlights the importance of managing leverage carefully and not overexposing oneself to a single market or asset class. In commodities, where prices can change rapidly due to supply shocks or geopolitical events, understanding liquidity risk and avoiding overconcentration is key. Hedging should be flexible, and strategies should be tested for worst-case scenarios to prevent similar failures.